Thank you very much, Patrick, for that introduction. I'm CPA John Dombe. I am the Client Service Manager at John Daniel Partners LLP. I highly welcome all the members, the construction and project managers who have taken time to join this conversation today. Mine is just to take us through a brief introduction about our firm. We are a CPA firm, John Daniel Partners LLP, a CPA firm based in Nairobi, Nanak House, room 305. Nanak House is just opposite Nation Center along Kimathi Street. We offer different services, including bookkeeping and accounting, audit and assurance. For audit, we do both internal and external audits, and also assurance. Besides that, we also offer tax advisory, and also other allied services such as we do due diligence, we do investigation services, we do process payroll, and general management advisory. So basically that's what we do. And we also, as part of a corporate social responsibility, we hold monthly webinars just to update the general public on any tax changes, or even delve into specific matters that would interest the general public. Recently, I think just last week, we had a webinar on tax essentials, basically for all standard businesses. And that is something we do every month. And besides that, we also have a tax masterclass. We understand that we may not be able to cover everything in these webinars, which normally last for an hour or so. So due to the demand by most of our attendees in the webinars that we hold, we curated a masterclass that now allows us to delve deeper into the matters that interest our audience at a very affordable rate of just 10,000, covering 5 days. And this one will start next month from the 6 to 10 of October. 5 days of intense learning. That's why we'll cover most of the topics that we may not even be able to cover today because of time limitation. So I welcome you all. In case you will be interested, we'll share the details for that. And also, in case you need any other customized advisory service, we are open to have that conversation. Something that I also need to mention is that we consult for software, mostly for accounting. We assist clients in implementing softwares like Zero accounting software, QuickBooks, and Tally. So that is just a recap of what we do just before my colleague and managing partner, Daniel, takes up. I think I'm done. I mean, I have finished my introduction, and now the floor is open for Dan to take up. Welcome, Dan.
Thank you. Thank you. Thank you, John, and good afternoon to everybody. Once again, welcome. I'm happy to be part of this discussion today. Thank you also for the management of the ACMK for getting that interest and looking at the interests of the members as far as the tax matters are concerned, and engaging us for today's discussion. My name is Daniel Chege, and I'm the managing partner of John Daniel Partners LLP. And I'll not go again to the introductions that have been given because already John has introduced. So I'll be running some slides, and as we continue discussing, I invite the participants to put up their comments, their questions, their areas of interest that they think they have in the chat area. Just put it through as early as you can, or as as it comes up, so that you can we can be able to attend to it. Because I have a strong team led by John, who will be looking at what has been raised, and maybe we can be able to discuss it here. If you are not able to discuss it here, probably we can engage even after this. So feel very free to join in the discussion. If you feel there's a contribution you can make, I think it will be good. But I'll try to limit myself to the time that we have, so that we also release the participants to engage in their other activities. So I'll be looking at just the background, and just to introduce, and already I'm doing part of that, and then we look at the key tax obligations. When we have a session like this, you can understand that people also have different backgrounds. So as much as they are construction managers, I want to believe that people have different different levels of understanding, especially as far as tax is concerned, because tax is technical. Tax includes legal issues, includes accounting, and of course there are industry specific matters relating to tax. So I want to believe, because there are many of their diverse backgrounds, there are people with different experiences, then we can only be able to address general matters. But that's why I'm really encouraging, if there are specific issues that you feel we need to address, then kindly engage, so that we can be able to address that. There is no need for introduction to say that the need for construction or the construction industry contributes a very significant part of our economy. And this is typical of any growing economy. Kenya is a growing economy, and growing, I mean, it's not what is considered to be a developed economy, which, if you have had the benefit of maybe traveling places like Europe, you might find construction, these cranes that are usually up in Nairobi, you rarely see them. Why? Because most of those areas have already developed. Maybe they have even houses which are already protected, as historical kind of structures. So with that understanding, we also need to know that the nature of projects and the projects that we are involved in as construction managers they'll cross over different accounting periods. And typically in accounting, we consider 1 year, 12 months as the accounting period. And it may not necessarily coincide with the calendar year. So we'll be having like the government's year, which runs from July 1st to 30th of the following calendar year. So that complexity of timelines, complexity of costs, huge costs, small costs, which are many, and of course, diverse tax obligations. It's kind of the scenario that we find ourselves in. And of course, coupled with that, we are using different players. We have contractors, we have subcontractors, consultants, those who are supplying us with materials, labor, and all that. And the obligations, again now, will also be relevant based on what we are doing. Company income tax is usually applicable to many people in the construction industry. Why? Because their companies' income tax is like the default tax. And this is not just in Kenya, because out of income, then the government wants to get a share. If you remember, even in the Bible, when Jesus was asked about taxes, it was, the government part. You have some money in your pocket, and even tithe. Again, I don't want to get to that discussion, but tithe is also based on income. VAT, withholding income tax, all those issues, they are tied to taxes. Imports, if we're importing materials, we're importing expertise in terms of, say, consultants. Those customs issues will also be relevant. With non-compliance, I'm sure this is not news. We already are aware about issues, non-compliance issues that can bring up problems. Penalties, which are specified in law, in our tax laws, to encourage people to be compliant. And then, of course, audits which maybe the taxman is not very happy with what has been declared and wants to verify. And then disputes which may arise, and disputes usually come because of areas that are not very clear. They could be business issues, they could be legal issues. Business issues, the dynamics of the business can bring certain level of understanding on one part and the taxman's understanding, mainly because the motivation is different. The taxman wants to correct taxes, to maximize correction of taxes. Then the person who is running the business, your biggest motivation is not to pay taxes. Your biggest motivation is to see your business succeed. So you'd want to pay as little as possible. And then, of course, it also goes without saying about the need to ensure that we stay on the right side, because you don't want the taxman bothering you when you are going about your day-to-day businesses. Already you have a lot in your hands. You don't want a lot of problems with the taxman, non-compliance issues. You want to stay in the right side of the law. So the basic tax compliance obligations, just to run through. I've mentioned about corporate income tax. This is based on our Income Tax Act, which is an old act, but an old act which is updated every year. what has of late become very, very controversial, the finance bill. I can't recall of a finance bill which did not include an amendment of the Income Tax Act. So it is an old law, but it's updated through regular amendments through the finance bill. It's usually the finance bill amending several laws at a go, but income tax is usually one of them. So the current rates of income tax, 30% for resident companies, that's 7% for non-resident companies. This is a general. There are some reduced rates which have been put for special economic zones, export processing zones. And if you have seen it also in the media of late, like what has been called the Nairobi International Financial Center, companies that would, the government would want to encourage companies to, big companies with a lot of resources to invest in Kenya, and they have tried to come up with special rates for such institutions. If you don't file income taxes, late filing, you are penalized at the rate of 5% of the tax due, or 20,000 shillings, whichever is higher. Now, note that there is filing and there is also the payment. When you file, you are filing to tell the taxman, this is what I earned, this is the much I spent, and therefore this was a taxable profit. And because of that taxable profit, then using the rate which is provided in the law, this is the much I should pay. That's filing. But then out of filing, you also pay. So if you file but you don't pay, there is also a penalty of 5%. And of course, as long as that tax stays unpaid, there is interest which accumulates at the rate of 1% per month. Then payroll-related taxes. Payroll-related taxes, they will be income taxes to the employees, not to the company. Remember, you are paying salaries to your employees, so they are earning. That is income out of employment. So they are supposed to pay taxes. But then it happens that the laws have placed an obligation on the employer to deduct. This is for administrative purposes, of course, administrative convenience. You have employed 10 people, then you deduct and file one return, and you pay one amount out of the salary, the salaries of those people. Then you remit to the KRA by the 9th of the following month. And of course, with what we call the graduated rates, the taxman of our tax laws have tried to be fair to those who are earning less than 24,000. That's done through what is called a monthly relief, so that those who are earning 24,000 and less don't pay taxes. But alongside with that, let's remember there are also other statutory deductions, statutory obligations. They are not taxes in themselves, although one may argue differently. Social Security contribution, for sure that's not a tax, because it's basically it's a pension arrangement, but it's mandatory again for employees to contribute through their employer. And then SHIF, which has become, of course, controversial of late, and affordable housing levy. Now, these are deductions which are done through the payroll. And that's why John, in his introduction, mentioned that some of the services we provide include the processing of payroll for our clients. Now, income tax for companies, you pay through installment taxes. Maybe let me make it very clear so that we don't get confused. Since the taxman wants money as soon as possible, he wants you to pay the amount in installments, the income tax that is due in any particular year of income. So the expectation is that you estimate your tax liability, and you estimate by looking at what your liability was last year, and then you apply the rate of 110%. That's assuming a 10% growth over the previous period. Or you have, if you have a more accurate way of estimating, then you use the current year's estimate. Now, this is eligible for those whose tax liability is 40,000 and above. So you pay that amount in installments by the 20th of the fourth month. So if your year of income runs from January to December, then it means on 20th of April, you're supposed to pay the first installment. Then 6th, that is the 20th of June, then 20th of September, and then 20th of December. Then the balance, which you can call the last installment, you pay 4 months after year end. Now, this is the assumption that because of you are using estimates until you have closed the year, you have not ascertained the exact amount. And that's why the balance is coming in 4 months. But as I said, the year of income may not necessarily coincide with the calendar year. So that's why we are using the 4th month, the 6th month, 9th month, 12th month to take care of somebody whose year of income is running different from the calendar year. Of course, this is not for everybody. This is employees. If, for example, your income is from employment, then it's already catered for under pay as you earn arrangement. Or if it's rental income, then you are filing on monthly basis. Or if you're under turnover tax, which again is a different regime. Or if you are exempt, like charities, which are exempt. But charity, don't assume you are doing charitable work. Don't assume if you are in that area, you have to apply for exemption so that you are granted the exemption. It doesn't come automatically. If you underpay, there's a penalty of 10% of the installment tax due. In other words, the taxman is trying to make you try to be as accurate as possible in giving the installments so that you don't give a small amount than the actual. The need to pay the taxes in installments. Why? Because the taxman wants the income tax due in bits, so that you don't have to wait until the year end. So installment taxes, you try to be as accurate as possible in ensuring that your estimates are good. They are as close as possible to the right amount so that you don't get that penalty of 20%. Now, the other bit is withholding income tax. And again, this is a way of getting income tax. Strictly speaking, even pay as you earn is a way of getting income tax for employment income from employees. So withholding income tax, this is where you are going to withhold when you are making the payment. At that point of making the payment, then you withhold part of it and remit that amount to the taxman within 5 days of making the payment, or within 5 days of the deduction. The assumption is that you are making the deduction as you make the payment to the person you are paying. Now, who do you withhold from? If you are paying somebody for professional services or management fees, mainly consultants, and I'm sure this is big in your industry, then the amount, if it's above 24,000 shillings, is 5%. That is per month. And this one you have to be careful, because if you are making multiple payments to one person in the same month, then the whole amount is considered. So you don't pay 15, another 15,000, and then assume it's still below 24,000. Is the amount per month. So 5% for residents and 20% for non-residents. So you have to know the residence status of the person you are paying to. And of course, you can guess why, because the government would want the rate of 5% to apply to its people who are within Kenya, or people who are operating from Kenya, and then 20% for those who are not within Kenya. And sometimes you have to be careful here. It's good I give some caution, because the organizations which are based in Kenya, and they are operating from Kenya, you meet them. But when it is time for payment, the invoice is coming from, say, Mauritius, or is coming from London. Now you have to be careful, because the invoice is what to be looked at. And if you are paying to the invoices to a non-resident, then that's what to be considered. It's not who you are dealing with locally. For contractors, the amount is 3%. If you are paying contractual fees, 3%, commissions 5%, interest income. This one comes when you earn interest. This is on interest income, like from a financial institution, like a bank. You have earned interest income. Then the withholding rate is 5%, and income tax, dividends, which is basically distribution of profits. Then those who are distributing to the shareholders, it's 5%. Of course, as I said, remittance, you ensure you remit within the 5 days. Then VAT, and VAT is a big and usually brings a lot of controversies. Some calling it very annoying taxes, but it's good to accept that we are in the VAT era. VAT started mainly in the I think in the 80s. In Kenya, I think it was introduced in 1990, replacing the old sales tax. There are some countries which still use sales tax, but in Kenya, we have VAT. And VAT, the rate applicable is the standard rate of 16% of the taxable value. So for businesses, you need to register for VAT if your taxable supplies exceed 5 million in a year of income. So taxable supplies is like the turnover. And here we need to know that this applies to both goods and services. if you provide goods which are subject to VAT, those are the ones we'd say vatable services, or the taxable services under the VAT Act, which is VAT. VAT was replaced in 2013, so we have VAT 2013 Act. So if you are providing taxable services, consultancy services, goods that, generally what is subject to tax. And by default is almost everything, apart from a few. And those few are exempted. There are schedules in the VAT Act, which lists what is exempted. So it's of course good to know based on what you do. Of course, in construction industry, you'll have being subject to VAT, but depending on what other business you are doing, you need to know if there are certain goods or services that are exempt from VAT. And then, of course, you remit the VAT the following month by the 20th. What are you going to pay? You are going to pay what you have charged your customers. You have charged your customers VAT. The accumulation of that is what is called ordinarily output VAT, what you have charged your customers. Then you reduce that amount by what you have been charged by those you had invoiced. So, sorry, those who had invoiced you, or those who had billed you. They had billed you plus VAT. That is input VAT. You have charged your customers, so that is output VAT. And that's why now with the e-teams, that amount is easily derived, since whoever is invoicing you or whoever is billing you is giving you e-teams, and it is accumulating somewhere in relation to your PIN. And then when you issue an e-teams invoice, again, it accumulates, pointing again to your PIN. So iTax already has the amount that is due from you for VAT purposes by the 20th of the following month. Of course, there's a penalty if you don't file VAT, and that's a rate of 10%. That is per month, of course, because the return is for every month, or 5% of the tax due, whichever is higher. Again, penalty for late payment is 5%. As I said, the penalty is for both filing, for non-filing, and for non-payment. Withholding VAT. Note that we had mentioned withholding income tax, but for some institutions, the government has appointed them as withholding VAT agents. So you must be appointed by KRA as a withholding VAT agent for you to withhold what you have been billed. Then it is at 2% of the taxable value. Now, you can guess why this came up is because many people are charging VAT, but they were not declaring and remitting to KRA. So this will not be an extra amount for VAT. It's just reducing on your VAT, it's basically crediting to offset your VAT liability. So if you have withheld, you show what you have withheld, and if your customers have withheld when you have invoiced them, then likewise it will point to your PIN. Again, what you have withheld, you pay within 5 days of withholding. I had just mentioned about e-teams, which is electronic tax invoice management system introduced by KRA. And this is basically KRA trying to utilize technology to ensure that it is able to ease administration of taxes. And this was done in 2024. It was initially an administrative thing. There were even pilot, taxpayers who are piloting, but of course this has now been cemented in law. So something that has come up and very important, and we are getting into a very interesting era, because now if you don't have e-teams, then the expense is deemed not to be allowable for tax purposes. In other words, the taxman is saying, for you to say these are my expenses, then each of those expenses should be supported by e-teams invoices which are already in the KRA database. This would be very interesting, and it's not unique to Kenya. It's good to mention that. Rwanda started quite some years back, and it's already working. Tanzania, it was also introduced before us. The extent of its success, I'm not very sure about, but it's nothing unique. It's basically trying to match what people are doing. We are basically be trading, or we've been doing business with KRA looking. What KRA is looking, because the person you are paying, the person who is paying you, KRA is aware. Then, of course, there are some exemptions. Emoluments, basically those to do with employees, as those are already handled through the employment income, and you are going to declare employees, you are going to declare the individuals, you are going to declare how much they are earning. Again, if it's to do with imports, because imports, they are handled under the East Africa Customs Management Act. So if you are doing imports, then the issue of e-teams will not be I mean, the already KRA has that information. Investment allowances, these are allowances which are to do with if you have invested and you have there are some certain incentives, let me call them incentives, which are given by the government. And those incentives, like the ones I mentioned under the export processing zone, or the special economic zones, if you have certain allowances, like you may not be in any of those zones, but because of your investment, the nature of the investment, there are certain deductions which you are allowed to have in law. And those ones, including even capital, what I would call capital deductions, they generally like wear and tear, because the wear and tear is the other name for depreciation. The taxman uses the word wear and tear. And of course, this will is again provided on how you go about it. Airline passenger ticketing, if you are traveling through, using an aircraft, then there is an air passenger service charge, which is charged per person, per journey. Then in case of interest expense, for example, which of course we will expect to be documented through a financial institution and through contracts, and this can be tracked through bank statements. So those exemptions are there. And as you can see, the taxman is really trying to utilize technology to ensure that there's reconciliation, and the different parties who are working, they're able to, KRA is able to know what is going on. The other taxes which are applicable, import duties, and if you have ever imported goods, you have seen the point of entry. You have to declare that. Based on the declaration, there are certain import duties which are applicable. Depending on the item, there are different rates. It could be 25%. Depending on what you are importing. So every item has its own rate based on what is called a customs value. It's a discussion we may not be able to get at this point. Then there is import declaration fees, this railway development levy, and of course VAT if you are importing, then there is a VAT you may pay at the point of entry, and that VAT then you'll be able to recover based on since you have already paid, but you pay at the point of entry. You are not paying at the point of selling. That's why it's called reverse. Then there are also excise duties which are applicable, and those excise duties they're dependent on certain items. Excise duty used to be called sin tax because it was mainly applicable to what were the things that were considered like rubbish, like beer, alcohol, generally cigarettes. But now it extended even to transactions like airtime, transactions, electronic. So the government has also extended the boundaries of excise duties. Even when you are importing certain items, excise duty will be applicable. So there are 5 days after payment. Remember, this is just like a summary. After withholding 5 days, that's withholding VAT and the withholding income tax. Withholding income tax, people usually just call it withholding tax, but it's basically on income tax. Then on the 9th of the following month, which then anything to do with the statutory, and here remember we are considering the calendar month. So by the 9th of every month, and then for VAT and excise duty by the 20th of the following month. Let's get into issues that will trigger KRA tax audits, especially for the construction industry. Good, I mentioned that in Kenya we use a principle that you declare, and that's what the government expects you to do. You declare what you have earned. And the KRA as the administrator, remember KRA is just an administrator of the tax laws. It is an agency of the government to just administer the laws. The laws are passed in parliament. So KRA will just take the information you have given it at face value. They'll just take it as you have given. But of course, we all know human beings are not always sincere, and they can even make mistakes even if they are sincere. So KRA has its own mechanisms of ensuring that it is able to verify, to deter those who may want to cheat, or those who may make mistakes. They are able to correct, and of course, with the appropriate penalties. So if, for example, you had a perpetual loss, you are making losses this year, next year, then KRA is bound to ask a question. How is this business surviving? How is this business surviving? Are you lying? It's natural to think along those lines. And there was something introduced recently. I think, I don't know whether it's the current finance bill or the last year's finance bill, which limited the duration within which you can carry over the loss. It's up to 5 years. You cannot be in perpetual loss for more than 5 years. That means it's not that you can be, of course, but the period within which you be allowed to carry over the tax loss. To carry over that means you are getting a benefit, so that in the following year, even if you make some little profit, then based on the loss you had incurred last year, you are able to carry over that loss and therefore not pay tax in the current year. If you don't match the incomes as per the VAT returns and the company's annual accounts, this is where it gets interesting. Remember, you are trading on a day-to-day basis and you are issuing ETIMs, invoices. So all your invoices in one particular year should be the total turnover. You have been trading from January to December. You have been issuing invoices. Then the assumption is cumulatively, those invoices should give us how much you have. The total sales, the total turnover for that year of income. So if what you declare in the annual income tax declaration differs from the VAT, then the taxman is bound to have some questions. Then expenses without matching income. You have spent, and of course, as a business person, you are in business. You are moving up and down trying to make money. So for every expense, it's an expense in pursuit of income. It just follows that because of this job, therefore these expenses. Because of this job, then again related expenses. And of course, with every job, it also means we are going to invoice for that job, or at least part of it, because as we said, the projects will be crossing different accounting periods. So the expenses that don't seem to match, they don't seem to be related to any income. And here you'll find over time, the taxman is trying to make the opportunities for these kind of misdeclarations very limited. A good example, and I know in Kenya, it's usually very common for somebody to say, for you to get this job, you need to give people, you need to oil people's hands. Somebody needs a kickback. It gets to be interesting, and it will be going forward, because that is an expense to you. You have done a job for 50 million, and you have spent 5 million, which is equivalent to 10%, to give, I don't want to call it a bribe, you are giving a thank you to whoever helped you to get a job. So the 5 million is an expense according to you. But then the taxman wants to know, what expense is this? Then it becomes, where is the invoice? Or who billed you for this amount? That's where now you need to be very careful in your accounting. And you don't want even to cross over from the tax side, and then especially if you are dealing with public institutions, if you are dealing with the government, and you start crossing over to what may interest the ethics and anti-corruption commission. You want to be on the right side of the law. So be careful. Inflated or unsupported site expenses. The kind of expenses you have for every job who are you paying? You are paying for labor. There are schedules of people you are paying. Who are these people you are paying? If you are a contractor, for example. If you are a developer, probably you are just paying the contractor. But the contractor, the expenses of a contractor also needs to match what is going on. And it's good to tell you that KRA has also invested a lot in some of the tools that they're able to compare one project to the other. They know the industry benchmarks. So those are the outliers that will come up with the analysis that the KRA will be able to do. And then the reputation of whoever you are dealing with, the parties you are dealing with. Nowadays, our institute, the Institute of Certified Public Accountants of Kenya, has been fighting the non-registered auditors. So try to deal with an auditor who is licensed, fully licensed by ISPAC. ISPAC gives annual licenses. So KRA has that of who is licensed, who is not licensed. So be very careful about who your auditor is. Ask for the annual license, a license every year. It's not that because I qualified, I have CPA, or I got a registration certificate to practice 10 years ago, doesn't mean that I should sign accounts. Every year, auditors get licenses. So ensure that your current auditor or the person you engage has a current license. For purposes of payroll, there are discrepancies between the pay as you earn returns and the company's books. Because you are paying your employees, you have a figure called salaries, expenses. And this figure should be the accumulation of how much you are paid every employee per month, total for the whole year. So what you have declared and paid and a pay as you earn should automatically match with what you have declared and paid as expense. And it's good to mention here, because I remember some cases where somebody will declare expenses, salary expenses, then you are not filing pay as you earn. Again, the taxman will be asking, how can you be having a salary expense, but every month we don't see pay as you earn returns? Those are the triggers. Payroll miscalculation, cash flow employees versus the people who are paid on a fixed amount and they are on, in your payroll, versus the laborers that you engage and pay on a daily basis. Those laborers are contractors. You need to be very careful, because now these cash flow employees, how you classify them will also be of interest to the taxpayer. I've seen institutions that outsource cash flow employees. You, as an institution, you have another body that is employing those laborers, and those laborers, they are paid by that other institution. Then you get a monthly invoice or a certain invoice, a single invoice that now you can pay, you can deal with one invoice or one bill. If pay as you earn is not paid on time, again, that can trigger. Then there are fluctuations, they are moving up and down. Are you filing and engaging employees? What is this that is causing the fluctuation? Of course, the non-filing and non-remittance of pay as you earn. For VAT, if, as I said, there is a difference between the sales as amount, the turnover for the year is different. VAT becomes very easy nowadays. They are even sending immediate email messages when you have declared somebody billed you, and then that person has not declared on their side. Remember, when somebody has billed you, is input VAT, and to you, you are declaring. Of course, there is that quick incentive to declare you have been billed VAT. But then the person who billed you, if they did not declare, then you're about to have problems. So you also need to know who you are dealing with. Those are the kind of things that can trigger. Then VAT refund claims. If you claim for refund, KRA will always be seek to verify those refunds. Refunds for VAT are usually applicable to people, the businesses that are ordinarily on credit basis. And this mainly affects exporters a lot. So the construction industry probably, unless the project is exempt, there are some projects which they may be having special treatment based on certain agreements with multinational donors and all that. Then you have to keep your records right, in other words, so that in case KRA wants to verify those claims, then they can be able to go through the records and confirm what you have claimed. Late filing of VAT returns, and of course non-payment, non-remittance, general non-compliance with VAT regulations. In general, basically the taxman is trying to tell you if there are certain things that you are not doing right, then KRA can be able to tell. And as I said, the KRA has invested a lot in some of the systems. So intercompany transactions, you have to be careful about if you have related companies. I know people incorporate multiple companies so that they compete. They are the one themselves competing, but they are wearing different attire, so to speak. So how you do it, remember these are two legal entities, they are different. Make sure you don't just be casual in the way you account for each of those companies. Information emerging from audits of other entities. The person you are dealing with is being audited. And KRA can see you have invoiced a lot that client. Then they will be interested to see how you declared on your side. They are also informers. It's good to know that KRA has a program of informers and they are paid, they are rewarded. It's in law that if you know somebody who is not paying taxes or is not declaring taxes or has a scheme of evading tax, then there are people, and here you need to be very careful because even ex-wives, ex-husbands, ex-girlfriends, people you are very close to can walk into KRA, disclose a lot of information, and KRA will look at that information and assess whether it's worth pursuing that case. So it has to be substantive information, and that's why the people who are very close to you are the ones who are likely to give that information. It's not just a rumor, like a guy just looks at you and says, this guy must not be declaring, he's driving a very good car, he's building a very good house. It's not just that. These are people who can get your bank statements, people who can get even download your accounting information and walk into KRA and say, so and so has not been declaring for this years. I know he declared this, yet I know this. And based on that information, they are rewarded. And the rewards are quite significant. So there is enough incentive for that. And of course, what is out there in the media, people will be interviewed. I'm holding an interview on TV. I want to show a very lavish, a very successful lifestyle. I want to put a lot of billboards and advertisements. I'm not saying you don't do that. Make sure as you expose yourself, you're also in the right. Avoid mixing personal and business income. This is where accounting becomes very important. Our approach has always been the first rule of tax compliance is proper accounting, proper record keeping. Don't underestimate accounting. Why people underestimate accounting is because their focus is to get business. Their focus is to look for business, to look for customers, look for projects that you can be part of, and therefore you don't bother to maintain records. Why you find it as a bother, is an expense, it's cumbersome. So it is one of those things that you can ignore, but it can really undermine your business. It can really give you problems 1 year, 2 years down the line. Because of what you think are small transactions, they can accumulate to be very big transactions, especially if a question is being asked 2 years, 3 years, 4 years down the line. You don't even know where those records are. But the taxman just wants to confirm. So you be very careful. If there is a law called, I think, Limitation of Actions Act in Kenya, which gives up to 7 years when the contracting parties or there is a legal issue and you have not taken any action. KRA provides for up to 5 years to do an audit, expects you to have, it can do an audit up to 5 years ago. But they can go even further if you have been suspected to have engaged in certain criminal or fraudulent activities generally. Don't ignore any messages from KRA or tax updates. Get interested. Why? Because it matters for your business. It matters for what you are doing. How do you navigate tax audits disputes with the KRA? The KRA uses a risk-based selection risk-based selection. That means they're able to use a certain framework in knowing which areas are risky, which ones are not. They have industry benchmarks. They have invested in business intelligence. And you'll be surprised how much KRA will know about you. And not just KRA, the government basically, because with the technology nowadays, your phone, your bank statements, there's a lot that can, even as you transact, you are transacting with the people, then this information is out there. So be very careful, be very careful. And then, of course, if it is auditing, they'll specify what area of audit. Nowadays, they have what they are calling return verification. It's a very polite way of saying, we are not sure you have declared things right. Let's just confirm what you are telling us. And you'll find they have not selected you at random. They have not just taken you out of the blue. They already have done their bit. So they'll tell you what areas they want to check, whether pay as you earn, whether VAT, depending on what information they have. They'll first notify you. This is provided in law and even in their what they call taxpayers charter, what they have promised the taxpayers. They notify you. They request for certain information based on what they have reviewed. They'll tell you this is what we have found, and therefore pay us the amount. This is what we have assessed. If you have evidence to counter that, you provide that evidence. It's always good to engage KRA officers early so that you are able to remove those problems early, so that you provide the evidence early if you can, so that it does not cost you again to discuss those issues when they are already in formal communication and they require several signatures to reduce or cancel. You may engage those people properly when they are already with you, they are interacting with you, you have their phone numbers, you have their emails, and you're able to provide the evidence. So to prepare, you need to invest in accounting, and you understand the requirements. What requirements are relevant for your business? Don't assume you know. Talk to professionals. You may be a professional in your area. You may be an engineer in your field, an architect, a construction manager. Even if you are an accountant, yes, it doesn't mean you know everything. Nobody knows everything. So try to be involved and get to seek advice. And of course, as I said, maintain proper records. Ensure that you have a proper filing system that you can easily retrieve. It will not cost you an arm and a leg. If you have poor files, a poor filing system, and somebody is penalizing you 50,000, you'll be surprised many people would opt to pay the 50,000 than go, checking in records. Why? It will be very cumbersome. It might take several days, several weeks to go through and check records and compare. So you make sure you have records that can easily be identified, can easily be retrieved. And then make sure you are, as an accountant, if you are an accountant in the industry, you are able to reconcile, regular reconciliation. Reconciliation is usually the determinant of how accurate the accounting records are. If you're a manager, you are the boss somewhere. Make sure you are following up your accountant. Are they reconciling the bank statements properly to the cent? That shows that the money in and out of the bank statement is properly accounted in your accounting application. Identify weak points internally before KRA comes. Even if they come and you already know there's a mistake you did or there's something you didn't do, you can cross your fingers because you already know what your problem is. So as much as they'll ask you other questions, then you can be able to answer those other questions. The question where you know there is a problem, you can just cross your finger and assume they not know. And of course, as I said, seek advice early. Don't go to hospital when you are critical, when you're in a critical condition. You are very desperate. Try to go to a professional in good time so that you are able to address the issues in time without a crisis. When you are being audited by KRA, only provide the document you've been requested. Don't be overgenerous. Here, this is a moral dilemma because you don't know what they know. You don't know what they know. So you ask for this, give them what they have asked. Clarify technical issues with evidence. They try to get what exactly are the key issues here. If, for example, there are expenses to do with the project, before you start a project, there are mobilizations. You finish a project, a certain amount was retained. What does it mean? Try to be very, very engaging on such things. And then try to retain the records, including what has been done in a conversation, in a face-to-face conversation or in a telephone conversation. Ensure it's written and you can be able to track it. Ordinarily, when there is a dispute with KRA, we'd all pray that we don't get into disputes with KRA because there are distractions to our day-to-day businesses. But you're supposed to object within 30 days. and you're supposed to pay what you don't dispute. If, for example, an audit has been carried on you and you've been assessed and you've been told 10 million is what you should pay additionally. But you can see out of the 10, for the amount to be 10 million, they have looked at pay as you earn, they have looked at VAT, they have looked at income tax. And you can see they miss some records about employees. So maybe pay as you earn is the one in dispute, or income tax because of the salaries expense. Then for you, you look at what is not in dispute and you pay. That's what is expected. Then KRA is obliged to respond within 60 days. This clarity has over time come because of amendments, so that KRA does not have, an open, what is called an open check for, just doing it at whatever time it takes. So it's already bound in law to respond within 60 days. But they have introduced a mechanism called alternative dispute resolution. We know that going through the court system is usually expensive. Why is it expensive? It's time consuming. You have to pay lawyers. You might save ultimately, and especially if you are a big institution, you have the muscle, but you may want to avoid some of those distractions depending on the issue at hand, the size of your business. So engaging in alternative dispute resolution is a good approach, so that you don't have to go to tax tribunal, tax appeals tribunal. Tax appeals tribunal is basically a quasi court, let me call it that. It's like a court, but it's looking at technical issues, and it's made up of mainly tax professionals, experienced tax professionals, people with understanding of tax law, tax provisions. Then they look at what KRA is saying, what you are saying, and they make a ruling. And their rulings are usually authorities in even subsequent treatment of such matters. If you are not happy with the tax tribunal, you can proceed to High Court, the Court of Appeal, and ultimately to the Supreme Court. Of course, with such a journey, you can be sure you need to look at the amounts, and they ought to be worth pursuing. So, contractors tax checklist. And here you are not very different from any other business. Confirm that you are registered for certain obligations, the obligations that are relevant for you. If you have employees, you need to be sure that you are registered for pay as you earn. If you want to know whether you are registered, it's always good to log in into iTax, and even your PIN itself, your PIN paper, what you call the PIN certificate. At the bottom, it has the obligations, I think the very last line. So check and to confirm that if, for example, you have registered a new company, you used a lawyer to register a new company. You just told so-and-so register for me a company. And that person registered for withholding and for VAT. Then it follows that KRA expects you to start filing VAT. So including nil returns when you have not traded. So, and this is where it gets to be a surprise for very many people, because they didn't know about the obligations. Make sure you are careful, you know the obligations which are applicable to you. Update contracts with the tax clauses. Depending on how you are trading, who is to bear the burden of, say, VAT? The amount indicated in the contract, is it inclusive of VAT? Is it exclusive of VAT? If we are paying withholding, some like especially international transactions, they may not expect you to withhold. And if they don't expect you to withhold, then there'll be a dispute between you and the person you are paying. They will not be happy if you are withholding their money. They are looking at whether they are looking at the amount they are getting in their bank accounts. So be careful about the clauses in the contracts. Then you train your staff, in the relevant taxes. Ensure you expose them to know the obligations, and of course supervise them to follow up to ensure that things are moving right. And then your supply chains, your workflows. How is it flowing? Imports, subcontractors, what's the relationship? People don't want to have the burden themselves. They'll always try to shift to the other party. The issue of taxes, especially the government, may be an issue of the cash flow more than, because the government may not have paid you, but at the same time, KRA is expecting a return. And of course, you'll argue with the same government, but they'll not treat it like that. They will look at it in a very different way. They treat themselves as different institutions. And then you automate filing, ensure proper filing, the reminders. So in conclusion, before we get to questions, I know time has really gone. Try to be as tax compliant as possible. It's not just a legal responsibility. It's strategic. Why? Because your business, you don't want it to be undermined by tax obligations. If you look at the businesses that have been affected by tax disputes with KRA, some of them running into billions, some of them very big businesses. You have to be careful. You don't want those huge bills coming to you because of making a mistake. Try to stay compliant to avoid those audits, disputes, penalties. Be proactive. Try to build the strength initially. Good practices, proper accounting, engaging professionals, people who understand what they are doing, and and you are working together with them. Remember, it's your business. Don't just say so and so is handling. Get to know what is going on. Make sure your focus is on the business. Focus on the business so that you don't get distracted with non-compliance. I think I will pause there for now. And I have seen there are quite a number of comments. And I've seen my colleagues have been addressing them. So I think, John, I'll take it back to you so that you guide on handling those comments or handling any specific questions that the participants may be having. Thank you. John?
Thank you, Dan, for that wonderful presentation. We really apologize. We have taken more time than we had scheduled. But of course, it's due to that unforeseen issue that came up. I think we'll be quick in answering any question so that in maybe at most 10 minutes we'll be through, so that we don't take much of your time. There is a question I had seen from, was it from, let me try to retrieve it. It was asking about transfer pricing. Just to answer Kennedy Wafula, transfer pricing it's a bit broad. We may not be able to exhaust that but just to mention it in summary, it is associated with organizations or companies that are cross-jurisdictional and they transact with each other. Say the firm that you are working in or for is a subsidiary to a parent construction company, maybe in Dubai or in the US or in France or anywhere outside Kenya, and maybe you are transacting with them. Probably, for example, the parent company in Dubai sends some technical experts to consult for the subsidiary in Kenya. Since you are related parties, the law that guides transfer pricing requires you to transact in what we call arm's length manner. Arm's length principle, it means that the value or the price of your transactions should be similar to a scenario where you are transacting with another unrelated party. So that's generally what transfer pricing is, and it's a big thing, especially if you are working, if your organization is cross, it does cross-border business, and of course it is related to some other company outside the borders of Kenya. But that is just a summary. It's broad. The beauty is that we have arranged for a masterclass that one day, one full 2 hours session will be discussing transfer pricing. Maybe that is something that you can consider and get to understand transfer pricing in full. I'm looking at any other question. Mother is asking. Sorry, yes.
It's about VAT. What is VAT? Could you explain the first one is, could you explain the intersection between
Ali, please, could you please get closer to your machine? We are not hearing you quite clearly.
Can you hear me now?
Yes, please proceed.
So yeah, could you clarify the intersection of e-teams and the ETRs, including that machine? That is number one. Number two, I understand of the 20th every month policy. What happens if a payment has been done on 20th in the morning and your books are not still yet in order, that you can able to file by midnight 20th? Are you allowed to negotiate? Let's say you file on 22nd.
Thank you, Ali. I'll be quick to answer that. So for ETR and eTeams, ETR was the older version of the tax invoice management system that KRA introduced, I think in 2015. So ETR is the device. You remember the devices that were being given by KRA accredited vendors. But now that was not online. It just kept some register in it with regards to what you have been transacting over time. But now they did an upgrade to that so that we get to what we call now electronic. Electronic is live. eTeams is live. When you transact, since it's web-based, the transactions are relayed to KRA platforms and they're able to see what you are doing. Those devices are still working. The people or the companies or organizations that had bought them, they are still working. But in an instance whereby they fail to work, you cannot replace them. You will onboard automatically now to eTeams. But they are both acceptable in the eyes of the taxman. The other one is on filing. For VAT and payee and all these other filings that we do in the course of the year, if you are not able to file by the set date, say 20th or 9th, KRA will administratively penalize you. The system automatically penalizes you for not, even if you file 2 minutes after that day has lapsed. So that one goes that way, and I think there is no recourse for that. But for income tax, this is the annual year filings that we do. What you can do, or there is a window that KRA has allowed. You can file maybe the last day of June or the last day of your 6th month. After the end of your financial year, you can file whatever you have, even if it is in draft form, or even if you are not sure. Then you can file an amendment later. That allows you not to be penalized for not filing within the set time. So for the annual income tax, you have a recourse for that, but for the others, when you are late, now that is done, you get penalized automatically by the system. I hope that is clear, Ali.
Excuse me. Yeah, it was not me who answered, who raised the question, but I have my question.
Sorry, could you please allow the person who had asked the question to make some follow-up?
Okay.
The final bit was at what point do e-teams usually delay e-teams invoices? Because
I don't know whether John you can hear him. I can hardly hear him. I don't know whether he can be closer to his microphone.
oh sorry, can you hear me now?
Or increase the volume of your.
Not really. I think he was far away from his machine. Please.
Can you hear me?
Yes, please proceed now.
Yeah, I was asking. At what circumstances do e-teams invoices usually delay? Because I'm having a situation where filing was done 2 weeks ago, but the actual document is not yet out.
Okay, I get you. What is your name, please? I think I didn't get your name clearly.
Oh, it's Patrick. It's Patrick.
Okay, Patrick. Thank you. We've been having those challenges even with our clients. I think e-teams is still having those teething problems. Sometimes the system fails to sync, and so it fails to communicate with the main iTax platform, so that whatever you get after you have generated the invoice, e-teams invoice, if you try to recheck whether it is valid, you cannot find it. Normally that happens when there is some internet connection challenge. And I remember there was some time we had some discussion with the KRA guys, and they said that is something they are aware of and they are working to resolve. What is there if you are sure you did that and it's not, you are trying, or your clients, suppose it's an invoice that you did and your clients are not able to see it, you can engage KRA, of course, with the invoice that you had generated, so that they can be able to help and validate it. But it's a quite a common problem with e-teams. I think we move to the person who had unmuted to ask a question, please.
Okay, thank you. My question is, I was asking, all this long I've been knowing that withholding tax, as it has been discussed here, that withholding taxes, they're supposed to be remitted within 5 working days after the payments. But I came across some readings, I'm not sure where, but where exactly, but I came across a reading where it said that withholding taxes should be paid on or before 20th of the following month after deduction. So I wanted a clarification on which withholding tax, because I am a bit confused on this. Thank you.
Okay, your name, please.
My name is Ali now.
Okay, Ali, thank you so much. There has been that confusion, but I think it emanated from a proposal that was in the finance bill to align even the withholdings with the other, with VAT, for example, and other like the customs duty filings, which are done by 20th, even the TOT. But that was dropped along the way. Remember, finance bill proposes amendments or changes, but it doesn't mean they get to see the light of the day, especially when we are talking about the act that is signed by the president. So that was not passed. So what is the current position is you're supposed to remit the amount withheld within 5 working days.
Okay,
I hope that is clear.
I now get it. Thank you. It's clear.
Thank you. So Mother is asking when we are supposed to declare 10% retention as VAT output. Is it after the project has ended or when each IPC is raised? I think I'll allow Mother to ask that question verbally, but just before I do that, let me see. I think Festus, did you get that clarity? I just explained about the withholding tax. I hope that is clear. Filing and late payment, that is a question by, thank you, Felix. I see your thumbs up. So Felix is asking the difference between filing and late payment. So filing and payment, there are two things, and I think Dan shed some light on that. Filing is declaring. So you can declare today and maybe pay tomorrow or the day after. So both attract different rates in terms of penalties. So mostly filing attracts the highest. If you don't file, it attracts the highest penalty because you can file, then maybe your cash flows doesn't allow you to make the payment. So the penalty for payment is usually quite lenient. That's the difference. I think some questions here will need to have people voice their questions, like the one asked by Martha. But the question by Margaret has been, I think, comprehensively answered by Beatrice, my colleague. So I was just looking if we have any other question that I may have missed. So Martha, would you please unmute and ask the question, please?
Mr. Sorry,
Okay, good evening.
one more. Oh, just go ahead.
You
Sorry,
can hear
Mother,
me?
please hold. Okay, please proceed.
Okay, my question. I'm in construction industry. Hello, can you
Yes,
hear
we
me?
can hear you. Please proceed. Yes.
Okay, I'm asking. I'm in construction industry. How come I can't hear you?
Kindly proceed.
You are audible. You're audible, Mother.
Okay.
Please proceed.
Okay, sorry. So what happened when I'm raising the invoice? Well, maybe the client is invoicing us. They usually invoice us less than 10% retention. But when taxman told me like we're supposed to include that 10% and then do the amount we do all the amount inclusive VAT and then limit that VAT. But what I usually do, I just less the 10%. If maybe let me give an example. If the IPC was 14 million, inclusive the retention, which is maybe 1.4, which is maybe 10% of this. I'll do 14 minus 1.4 minus the retention, and then I will raise the invoice. That's what I'm going to declare to as my output VAT. But currently, I have been having an argument or maybe a concern where they're saying like, okay, most people who I consulted, they were arguing that I'm supposed to do the inclusive be it we have not been paid that 10%, I'm supposed to include when I'm doing my invoice, not just to wait until the project's end. Because ordinarily, most people think after the project has ended, that's when you are supposed to do the 10% VAT. So I just wanted maybe clarification on that.
Thank you. Dan, would you want to take that, please?
Yes. Let me take that. Thank you, man. IPC stands for what? Just because
interim payment certificate. Sorry for that, for using short initial.
Interim payment certificate.
Payment certificate. Sure.
Okay. Okay. What you need to look at is this is what the taxman expects. The tax is due. There's what we call the tax point, the point at which the tax is due and payable. The taxman looks at the earlier of three things. One, the invoice. Two, when the work has been done. I don't know, probably, something has been done to the transaction has been completed. Like say delivery of goods. Have something that has been done completely. You cannot say you have not invoiced and yet you have something has been done to the satisfaction of both parties. And both parties here, I remember what John mentioned about arm's length. These are two parties who are in business and each is looking at his or her side. And then, of course, when the payment is received. So those three things, the area of payment of when the money is received, the invoice, and when the work is done. Now, in your industry, the way I understand the retention is already part of the contract. And we have agreed as per contract that after you complete the work, we will retain 10% for a period of, I don't know how long, 1 year. So according to the contract, I will use the contract, and this one I'm using my own understanding. I'm using the contract as evidence of the satisfaction has not been done. Why? Because this is the period where you people look at in the fault areas, in areas that may require the contractor to address. So until the lapse of that period, then that, to me, that is money is not due as far as that first criteria is concerned. If you invoice the full amount, or if the contractor has invoiced the full amount, then that's a mistake. To me, that would not be the right way. The right way would be to invoice what is due. Because if you invoice today, yet the amount should not be paid until after 2 years, it means you have not earned that money until after the 2-year retention period. So the invoicing amount should be what is due and payable. And that goes to the second criterion. And then, of course, with the third one of money, then the payment, of course, if you decide to pay the contractor, then of course the money becomes due. In other words, you are avoiding you are making it void the lapse, the 2-year contract, sorry, the 2-year retention period. So the invoice should have been issued immediately. That would be my understanding. But I will want to hear from anybody else who has a different approach to that. Maybe there could be something I've missed. Thank you.
Thank you, Dan. I hope Mother is well answered. I would answer the same way Dan has answered that question. The tax point would be quite critical, and in that case, if you invoice the whole amount, then you'll be needed to pay for the whole VAT for the whole invoice amount. Do we have any other question? I would want us to finish by 5 p.m. There are some members who have requested to leave by then. But I see a question by Frida. Maybe I can just answer it. He's asking if you have registered a company with my individual PIN, and I'm earning income as an individual separate from the business income. How is tax declared? So Frida, I want to understand. I want to believe that because you cannot register a company by your PIN, maybe a partnership or a business name. So if you've registered a business name as a sole proprietor with your PIN, then you have other separate income streams. The law requires you to declare all that income under that PIN. But now what you will do, you will separate those income streams while you are filing. And I believe the template that we use to file the annual returns gives you that those particular spaces for both the business income and income from any other source. So if we don't have any other question, do we have any other question? Maybe if we have left out somebody, they can unmute and ask the question before we finalize. If not, maybe I'll give Dan 20 seconds to give his final remarks as we look to finalize. Dan, please.
Thank you, John. I think mine would be just to emphasize the importance of accounting, proper bookkeeping. And nowadays, softwares are available. They make life easy. Softwares that even include filing for every transaction, the supporting document for that transaction, so that you don't have to deal with manual filing or filing in a whole room. So be very, very, very strict about bookkeeping, proper bookkeeping. And I think that should be one very fundamental way, so that you already safeguard yourself from somebody asking you a question. Remember, KRA also makes mistakes. They'll make mistakes, and you can only counter them if you have the evidence. But over and all, I think tax compliance is an obligation we all have. So make sure you are in the right side of the law. Make sure you also engage with the professionals, so that you don't use what I would call the street talk. People don't know that tax issues are legal issues, and they are very specific to an entity. Very specific to an entity. Don't just get advice from your friends, your colleagues, and the way they are trying to show you the same issue, it could be different. Maybe one is registered as an individual, one is registered as a company, somebody else could be registered even under TOT, turnover tax. So be very careful, so that your issues are handled in a professional manner. Otherwise, thank you very much for the audience, for the participation. Over to you, John.
Sorry, I dropped off a little bit. John, will you go so that I finish? Or...
Yes, Patrick, please proceed.
Yeah, sorry, I'll come after you. Just one more thing, maybe because sometimes a client does not understand that an invoice is delaying, rather sees it more of a problem, even if you say it's KRA. So I'd like to ask, are there avenues that somebody can risk you actually pay the tax ahead of the invoice? I don't know if you've gotten the point. So that by the time the payment is coming in, the receipt is already out. Hello, am I audible?
Yes, you're audible, Patrick. I don't know if Dan got the question clearly.
I got he became audible the last minute after finishing the question. I missed the question.
Okay, maybe.
Let me repeat. Let's say, for instance, you are waiting a payment of, for instance, like 1 million. 16% of that is 160,000. So, no, is it 160? Yeah. So, instead, you file already for that 160, so that by the time the client is paying, already that invoice is out, because you are trying to avoid the delay of 2 weeks, 3 weeks. I think you have not gotten my question. How do we try to navigate around that delay of releasing of those invoices? Because it creates a lot of troubles.
I think, John, you'd want to handle that. All right.
Yes,
John.
If I got Patrick clearly, the delay with invoices, I think that is one challenge that most businesses are facing. I mean, even ourselves. And if I got the question clearly, in terms of VAT, the moment you invoice, even if the client takes a longer time to pay, the law requires you to file for that VAT and pay the same. Maybe I think that goes to our internal processes, how we have put in place measures to chase our clients to pay, because the sooner they pay, then the sooner we get back to our best state in terms of the cash flows. I don't know if Dan, you have something to add besides that.
Yeah, I think it's precisely that. Remember, here is not. Patrick, it's not that the money is due when you receive it. It's when you invoice. So the taxman will not worry about whether you've been paid or not. And that's why I had mentioned at some point that you may have even worked for the government and you have invoiced the government and they have not paid you. But when you invoice, then that amount becomes due. If you have not been paid, you can also use that later when you have the KRA is chasing you for penalties, to seek leniency of KRA, because they should be able to give you a hearing based on the circumstances that you are under. So whatever evidence you have, they may want. I know of cases where maybe somebody was hospitalized for a long time. Somebody had not been paid for a long time. And then, of course, when you are paid and when you invoiced, the evidence is already there. So you can now claim leniency from KRA as far as penalties and the interests are concerned. Thank you.
Okay, thank you. I think we can hear from you, John, so that now we wind up.
Thank you, Patrick, and everyone who took time to join this particular discussion. It has been exciting to get to hear your questions, also answer them, and also interact with you. And we hope since this was the inaugural webinar together, we can schedule for even some more in the near future. And also we can strike additional partnerships between the ACMK and John Daniel Partners LLP. So just to finalize from our side, we are really happy to engage you all. And in case there is any particular question or challenge that you are facing in the areas of tax, advisory, even accounting, bookkeeping, audits, everything that is within our realm, as I had stated, please feel free to reach to us so that we can be able to craft a customized solution, the challenge that you may be facing. We'll be sharing these presentation materials through your the emails that you used to register for this webinar. And also you can be checking out our socials. We also normally have bi-weekly tax newsletters that are aimed at also educating people on those topical areas with regards to tax. So it's good that you be checking out them in our socials and in our pages to learn more. Thank you so much. Patrick, could you please take up and maybe finalize?
Okay, thank you so much, John Daniel and partners. It has been an insightful session. Yeah, we look forward to more such talks because unfortunately things follows. No one really knows everything. At the end of the day, ignorance is not a point of self-defense. So yeah, I've actually gotten some few tips which will give me confidence in my next site meeting because I was grabbed on the neck. And yeah, so attendance certificates will be issued. Now this one will come from those who attended. They're usually two separate lists. There's a for registration and that for attendance. So the tracker will be able to tell us who attended, and such will be issued within the next 2 weeks from ACMK, and also still signed by the team leader at John Daniels and the team leader at ACMK. So asanteni sana, we look forward to more sessions and more activities. Make sure you reach out to them because you have seen that they are knowledgeable in matters tax and settling such disputes. Thank you so much.
Maybe before they leave, I will take also that opportunity to welcome them to the masterclass that we are preparing. And this one we have partnered with KRA. One of their officials will be taking us through the transfer pricing and international tax topic. So there is somebody who had asked about that. That will be dealt with comprehensively in this masterclass, and also other topics that are quite pertinent to your industry that we couldn't really discuss in this webinar. You can check out our socials for the poster and the details on how to register and pay. Thank you. I think members, now you can leave in your own volition.
This is brought to you by John Daniel and Partners LLP.